Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about a new report from national property management software firm Yardi. They're one of the premier software systems used by the majority of large-scale property management companies. The data is hosted by Yardi on their own servers. As a result, they have access to a lot of data on their servers, and they market those products based on that data under the Yardi Matrix brand. Yardi published the National Self-Storage Report at the end of January. This report focuses on the top 31 metro areas in the United States. It mirrors what we've known for some time. Storage in the primary markets is somewhat saturated with supply. Supply has exceeded demand. Nationally, Yardi Matrix tracks a total of 4,627 self-storage properties in various stages of development, including 812 under construction. There are 1,789 planned and 669 prospective properties. The share of projects under construction was the equivalent of 3.6% of the existing stock in December, unchanged from the previous month. Yardi Matrix also maintains operational profiles for 29,000 completed self-storage facilities across the U.S., bringing the total data set to 33,659 properties. The average national street rate for all unit sizes dropped on a year-over-year basis, down 2.8% in December. But the average rates remain above pre-pandemic levels. Rates for a standard 10x10 unit decreased 2.3% for non-climate controlled and 3.4% for climate controlled units. Rates for larger units outperformed those for smaller units on an annual basis, with rates for 10x30 units down 2.4% year over year and rates for 5x5 units down 3.4% over the same period. Most markets across the nation ended 2022 with a decline in street rates, but rates did remain resilient in several of the top metros, mainly in the southeast. For a 10x10 storage unit, non-climate controlled, 7 of the top 31 Yardi Matrix self-storage metros had an increase in street rates on a year-over-year basis in December. For 10x10 climate-controlled units, only 3 of the top 31 markets had positive growth, while rates dropped year-over-year in the remaining 28 cities. So rates continued to decline through the end of the year on a national basis, falling $2 to $132 from November to December. And that decline was broadly based, recorded in 30 of the top 31 cities. Pittsburgh, where rates remained level, was the only metro that did not see a drop in street rates for 10x10 units. Orlando, Miami, San Francisco experienced the largest drops in street rates for both non-climate controlled and climate controlled units combined at a $4 month-over-month fall in price. As these rates trend downwards, operators continue to focus on raising rates for existing customers to maximize revenue. Although increasing existing customer rents may prompt some customers to move out, it opens units for new customers at higher rates heading into the spring 2023 leasing season. So that's what Yardi had to say about the state of the industry. And you can expect downward pressure on street rates in primary markets. And why is that? Well, it's oversupplied. We've seen a lot of institutional money, a lot of REITs investing in those same 31 primary markets. Another article, published in Inside Self-Storage, speaks directly to our own strategy in self-storage. We've seen a bumper crop of secondary markets gaining national attention. We've seen smaller cities like Apex, North Carolina, Bentonville, Arkansas, Elk Grove, California, and Frisco, Texas, among some of the fastest growing cities in the United States for small businesses. It's these types of burgeoning areas that are becoming prime targets for self-storage investors as well. So let's explore why and how to choose an area for your next acquisition. Since the pandemic, more people are migrating to secondary markets, which means greater opportunity for self-storage investors. For example, several towns in Utah are enjoying an influx of residents who are leaving California, primarily for economic reasons. Many have sold their homes for a sizable profit, and they're moving east and south to enjoy lower housing prices and a higher quality of life. These folks are flush with cash. These consumers are buying lots of toys that will require storage, which they can now easily afford. But at the same time, we've seen an increase in interest rates, so they're not buying a home just yet. We've seen people move from major cities. They've reevaluated their priorities. They've moved to enjoy a slower pace, work remotely, or start a new career. They've shown that they're not afraid to put quality of life ahead of some of their professional goals. But most of these transplants are finding a low inventory of houses for sale, finding higher interest rates, so they're renting for now, waiting for interest rates to drop. As such, they're storing their excess belongings in self-storage units until they can find an affordable home. The pandemic also fueled consumer expectations around contactless service. So we're starting to see in self-storage greater acceptance of remotely managed facilities. The push to adopt new technologies has made it possible to add this in secondary markets. It's now more affordable to run multiple facilities, as many of them can be operated remotely with less staff. But even in a secondary market, you want a minimum size to the market in order to have a viable business. If the density is too low, it's going to be difficult to aggregate enough demand within the radius of your facility. One of the rules of thumb that we look at, in addition to knowing your actual population, is to find out how much storage is available per capita. Markets with 7 square feet or less per capita will have significantly better economics than those with more. So go for markets with low to medium competition. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.